Give me 23 minutes to fix 90% of your gold trading losses. The reason you keep losing is because you think gold moves like other markets, and that is 100% wrong. In the next few minutes, I'll show you the one candle gold strategy, how to avoid structure traps, key levels for sniper entries, where to enter inside a range, and how to read gold using DXY. Just a quick note before we start, these concepts also apply to other markets, but they work the best on gold. If you are trading anything else, you can still watch the video and apply the concepts. Now before we start the video, there are some bonus secrets. So this video here has 5 other secrets that you must watch, so you can watch this video. And also this video here, there will be one secret specifically about this one, but in order to understand the secret that we're going to go over, you need to watch this video too. So if you want to also learn more things about gold, you can watch these 2 videos. Now let's start with the first secret, and it is the fake market structure shift. So the market structure trap or the fake market structure is mostly how gold actually moves. There is a sequence that happens almost every time in gold. So if we notice this price action here, you need to understand the sequence. The moment you understand the sequence, you'll be able to understand the real market structure and how gold actually moves. Now you might ask, what is the sequence? But before that, let's start with the market structure trap. So quickly, what is market structure? A lot of people just look at it as a pattern without looking at where it's actually happening from. So regardless of the key level that we're looking at, they don't care if it's here or if it's here, you know, they only look at the pattern itself. So they look at something like this. That is a market structure shift, because what happened here is we closed below this low. So that is what they focus on. However, most of these, especially on gold, are going to be fake ones. They're going to be traps. So when this happen, so when this thing here happen, what you can do when everyone is looking to sell, then you look for buys. Why? Because the structure has been bullish all the time, and just because this happened does not mean that we are switching the trend here. So the sequence would be, you see, we're going up here, creating a low, breaking structure. But what happened here is this breakout structure was nothing but a liquidity sweep or fake market structure, and then we close above. That is your real breakout structure. That is your creation of a strong low, then we close higher. So instead of selling here when price goes below this level, you actually buy. And same thing here. So we had a breakout structure, we have a low here. Some people would be looking for, you know, to buy here, but you need a liquidity sweep. You sweep liquidity, and a lot of people here looking for a continuation to the downside because we had a breakout structure. But this is just a liquidity sweep before going higher. And same thing here. We go lower, we had this fake market structure shift, then going up. You know, sometimes it's going to be valid, especially if we're reaching a high, high probability level, and then lower. And you see same thing here. A lot of people are going to be looking at this as market structure shift because we sweep liquidity. But what's happening in reality is price reacting to this key level and then continuing lower. And this is the cycle. So what is the cycle? We have a creation of a low, we have a breakout structure, we have liquidity sweep, and then the breakout structure, the valid one, is going to happen. So it's always liquidity sweep of a low that a lot of times a break structure, which is not valid. That is a liquidity sweep here, and then the valid breakout structure. Then you buy on the retracement, and then you don't buy, or you don't look for, continuation for sells here. You look for buys because the major structure is being determined by these points. So you see, when we have liquidity sweep, breakout structure, that is a low, a strong low, and then that is a high. Breakout structure happens here, and then breakout structure might be happening here, but we need to take the low first. So when we take this low, that is where the next breakout structure is. But here we switch the trend. So you should understand the sequence here. Now simply take a look at gold on the daily time frame. What is happening here? What we can see is that we are bullish, right? So we've been bullish for a long time here. And every time price moves in a structure, it's like this, go up. And then you see here we have, actually I'm going to zoom in. We have a low that took a high, and then we had a liquidity sweep here, and then continue higher. And same thing, we create a low here, we don't take it, okay, but we take one here. You see prices going up, breaking structure, we have this low, we take this low, and then we take another low here, and we continue higher. And same thing, so not here, but if we go continue going up here, what happened is price going up, creating a low, going higher, creating a low, and then pushing higher. So a lot of people now looking at this as a breakout structure and this as what? As a market structure shift. When in reality, what happens is price just going below, lower, and then continuing higher. So that is what? A fake market structure shift. Now price is going up, going lower, going up. A lot of people are looking at market structure shift around this level. That is where the valid liquidity sweep happen. We continue higher. What do you see here? Same thing. We have a creation of a low, then a high here. We take the low. A lot of people looking at market structure shift here, continuing higher. What do you see here again? Now I cannot make this up. You see, we have a high, a low, and then a higher high, and that is where the market structure shift is. We had what? Liquidity sweep. And you see, this is what keeps happening over and over in gold. So now the question is how you validate the market structure shift. I mean, very simple. The price needs to be reacting of a strong key level, and that's something that I always teach on Edge School. The price needs to react of a strong level, and then the real breakout structure is going to be happening of this, or the market structure shift, in other words, is going to be closing below this level, because that is the major low that took liquidity and then breakout structure. That is the one. It should have been here. So when price is going up, it needs to break this low, not the internal ones. And we need to react off a key level in the first place. And I don't want to see prices expanding to the upside, and then there is a big range here, and then you consider this as a market size shift. It's just filling of this range and then going higher. You should, logically, this does not make sense that after this huge move, that this is your market size shift. It does not make sense. Now, secret number 2, and that is the wick entry. Now, this is something that most people don't talk about, and this is where I have my main focus now. This is where I enter. This is where I get my sniper entry. This is where I get mostly the best entries, either in gold or the Forex pairs. So let's think about it. When you have a big bullish candle followed by a bearish one, or vice versa. Now, the wick between them, it's not random. That is a strong key level. But you need to pick the one that works. Now, first we need to understand why is it a strong key level, because that's where most traders, get trapped in. If you think about it here, price is going up. This is where most traders get trapped. Same thing here, because people are trying to catch the reversal and it's not easy. So a lot of times they're going to get this liquidity sweep and then reversal. Now, if you notice here, when we have a bullish candle, then a bearish candle, what happens after? Instead of taking the liquidity here, price only comes to the wick here and the reverse. Now, if you think about this one, a lot of ICT and smart money concept traders, and there's nothing wrong with liquidity, but it's not the only thing. It's not the only way to look at price action. If you notice here, this is the low, it's not taken. But where does price react off? The wick here. So the start of the wick, that's where price react off. Now, if you think about it, for example, here, we don't take the liquidity, but we only react off the wick. Why is that? A lot of people are trapped here. There is a lot of orders that needs to be filled, and there is a lot of reasons that I actually, teach all of this in the Edge School. Basically, which one to enter off and how to have the best entry. But you see, a lot of times, for example, wick respected, price going up. Even here, wick respected, price going lower. Sometimes even against the trend. So you see, wick respected, going lower. It does not take the liquidity. Now, there are sometimes, indeed, there is nothing that is 100%. There are times where price does not respect the wick, but there are reasons that this is happening. And there are things that we need to focus on. So always watch out for these wicks here. These wicks are going to establish reversals. They're going to sometimes also establish continuations. When price, goes higher aggressively, it's going to retrace to these levels. Now, this is just an inspiration. I want you to think about how strong the wicks are. This is my main focus, the thing that I focus mostly on the Edge School, just basically trading based on the wicks. And think about this as the tip of the iceberg. That's it. Now, before we continue, let me introduce Edge School. After testing almost every trading strategy over the past 7 years, I put together everything that actually works to me into what I call now the Edge model. A simple universal framework based on real market behavior, not overcomplicated system that overpromise. Now, each school brings this model to life through core lessons, a focused community, advanced live and recorded workshops, and a full library of essential resources, all designed to remove noise and only build true consistency. Now, to be clear, each school is not for everyone. It's only for traders committed to long-term growth. If that's you, I would genuinely love to welcome you inside. Let's get back to the video. Now, secret number 3, and that is the 50% rule. Now, when you think about imbalances, when you think about any key level that you think about, when you have a defined key level, a lot of times the 50% of that key level is the one that is going to be responsible for the reversal, especially on gold. So gold tends to go to the 50% of imbalances, ranges, or wicks. So this is what we teach in the edge school, wicks, and we discussed this on the previous secret. So think about imbalances, fair value gaps, and think about the 50%. A lot of times, even when you have a strong level here, for example, what gold does is it ignores all of this and only goes to the 50% of the imbalance. Now, what is the reason? It's because a lot of people, actually most people, looking at this level in order to go long. But there is an imbalance here, and it's not smart to let everyone look at the obvious level. So what happens, and don't get me wrong, this level could work, price could come here, and it all depends on the timing of the trade and what is happening. The market is random, but what I'm saying here is that a lot of times I notice that price goes to the 50%, and I'm going to show you the examples. Also the range. So when we have this big range here, price tends to go and rebalance the 50% of the range, 50% of the range, maybe around here, and then start going up. Now 50% of imbalance. So you see price sometimes also goes to the extreme imbalances and then the wicks. So let's assume that this is where the candle body is and this is a wick. Price is gonna a lot of time go to the 50% of the wick. So let's say this is the body here, this is the 50%. Price tends to go and see this yourself. Look for, actually open your chart and look for the wicks that give a reaction, and you're going to see that a lot of times it's the 50% of that wick. Now if we look at what's happening here, a lot of people are gonna, when we broke above here, we broke this strong level here, a lot of people are gonna go and actually plan to go long from here. But what happens is what? And even though I know that we have this imbalance here that could push price higher, but I was just having an alert here and I was not available at this time. Well, what do you see? This imbalance, 50% exactly reacted. Now price went up. We have this imbalance here. And we focus a lot on the extreme ones, or the ones that we just start the range of. Okay, and same thing here. We have a lot of strong levels here. A lot of people are going to look at, order blocks and other things. But what happens is price ignores all of this and exactly went to the imbalance here. Started going lower. Now what do we have here? A lot of strong levels also. And we have this liquidity here. And this is what we discussed on the first one, right? The sequence. But what happened here is we also have something different, which is the 50% of the imbalance. Price started going higher. Now, a lot of times, and also here, so you see, after this strong move to the upside, what happened here is we had this strong level here. So this is where the initiation of the breakout happened. But what happened is price only coming back to the 50%, exactly to the 50% of the imbalance, started going higher. Now think about it again. What happened here? Now mostly I'm going to be looking at this level here, but because this level, the strong level here, aligns also with the imbalance, we could take the imbalance and you see 50% respected. And again, the edge model here, we have a wick respected. And also here, this is one trade that I wanted to enter based on. You see a wick respected here. But now if we look at the wicks and if price respect the 50%, so for example here, it depends if this candle is bullish, but most likely yeah. So do we have 50% respect? Almost at the 50%, almost. Now wicks, we have this wick here. There was liquidity sweep here. And a lot of times you're going to see that price actually respect the, the 50% of the imbalance, the 50% of the range, or the 50% of the wick. So how do you use that? You refine to that 50%. So you don't take anything unless there is a strong confirmation, then you can take from the, any other level. But when price goes to the 50%, you take more risk. Secret number 4, and that is the 20 or the 8 p.m. candle. So this is something that we discussed, but I wanted to recap and I wanted to give you an overall idea. But if you wanted more details, then you could go back to the video. It's going to be recommended to you now and it's going to be in the description. That is a full strategy just based on one candle, and that is the 20 or the 8 p.m. candle. Now, this is just a reminder for you, but if you want the whole picture, then you need to watch that video. We have two types based on the day, and there are other confluences that we'll be discussing in the future. But we could have a reversal, and mostly I focus on the reversal because I think it's more, specifically in the strategy, it's more clear and it lasts more. So the 20 candle. Now this is EST time based on New York time. We have this 20 candle. If price decided to take the high or the low, so basically we sweep one side of the 20 candle, that means we could have a reversal. So if this is going up and we sweep the high, that means we're going to be moving lower. It could be a short-term move or it could be a move for the whole day. And you could be catching the high of the day or you could be catching a small move. Now, this depends on other factors of the market at that time. Now, continuation is closing below, and there is a displacement below the 20 candle. So below, or it could be above. So we could close above and go aggressively above. That could be a continuation. So we could be having a move to the downside. It could be again a short term or it could be a long term. It could last for days or weeks. This is only based on one candle. That is the 20 candle. Now for more details and examples, you have to watch that video. It's going to be more clear and it has all of the steps for you. Now secret number 5, and that is the DXY mirror effect. We need to understand, and there is a misconception that gold just trades the opposite of the DXY when it's partly correct, but it's not fully correct. Gold does not just move opposite to the dollar, but it reacts in layers. What does that mean? Sometimes it mirrors, which means that it just does the opposite, but sometimes it lags, and we can take advantage of that lag. So think about it this way. If we have DXY, what it's doing is moving up, and then we had a liquidity sweep, and then a strong breakout structure to the downside, but it just, disrespected this level and it disrespected everything here, and most likely is going to continue lower. So we had a strong breakout structure. It's not just a liquidity sweep. And then we have a reaction of a strong key level. So DXY has already moved lower, but gold is just staying here. So there are different reasons for this. The market is random, but what we can anticipate is that gold is most likely gonna follow through the same with the DXY. So whatever the DXY did, gold is gonna do the opposite, even if it lags, even if it happens a few hours after, or half an hour after. And maybe gold did not reach the level that it wanted to reach. So there is a strong level here. It's gonna go lower first when DXY is consolidating, and then move higher. So what we're expecting here is that gold is gonna follow what DXY did even after time. So this strong move to the downside, we're anticipating the same thing to happen with gold and then go higher. And maybe DXY is consolidating or continuing going lower. So when this happens, when DXY moves strongly, basically that is the main premise of the secret. When DXY moves very strongly and then gold does not move, we anticipate that gold is gonna follow what DXY did even after some time. So you can take advantage of this and anticipate that we have a potential move that is happening in the future in gold. Now, if you notice here, this is the comparison, and this is gold, and this is DXY. A lot of times when we have a strong move on the DXY, so if we look at here, when looking at gold, what happened here, exactly at this level, and then looking at DXY, marking the same on DXY, if you notice that this candle on DXY is very, very strong, when in gold, it's nothing. It's almost nothing. And then gold keeps consolidating here when DXY is moving really strongly. And then if you notice what happened after, is that at this point, and this is on the daily, but it can be applicable on any time frame. So what happened here is that gold is starting to, it's actually doing nothing. But DXY here started to slow down. And what happened after is price on gold getting to a strong level. These are levels that I, always suggest for my students to enter from. And what happened after is price, actually this is yeah, I guess a trade that I entered. So what happened is DXY consolidating here, but gold is moving higher aggressively. So here, this is what's happening. This is what I mean. Now, sometime it's gonna be the opposite. Sometime it's gonna lag more and more and more. But we can take advantage of this scenario, especially when we know that gold is actually reaching a strong level and is doing the opposite now, just to go to that level and then react. Now, same thing happening here. If you can notice that gold only started to go up around this level. Actually, there was some reaction here. So reaction here, going up. But you notice that actually DXY has been going lower from this point when gold was only consolidating. So we know that DXY is moving lower. That means gold is gonna follow through, and that is what happened on the next candle. Next candle just exploding to the upside. That is how you take advantage of the lag between gold and DXY. So that's it for the video. Hopefully you learned something new. Make sure to watch the other videos to get the whole idea and the whole point. If you like the video and you think that is going to help other people, then make sure to share it with your friends. Hit the like button and subscribe to the channel for more videos. And also make sure to check Edge School if you want to simplify your trading and discover your edge. That's it. This is Mulham, and I'll see you in the next video.